2026 is coming, and if you want to build real wealth through property, the next 12 months will be absolutely critical. For those who don't know me, I'm AJ, Director at Handle Properties, where we buy around 4 high-performing investment properties every single week for clients across Victoria, Queensland, Western Australia, and more. We've now helped hundreds of investors scale their portfolios, going from zero to multi-million-dollar property portfolios within just a few years. Our job is simple: find markets that are about to explode, buy early, recycle equity fast, and repeat the process all over. And based on everything we're seeing, 2026 is shaping up to be one of the biggest years of capital growth in Australia that we've seen in this decade. But don't just take our word for it. Let's start with the data. Domain has released their price forecasts, and the numbers are wild. Sydney, up 10% in terms of growth to a median price of around $1.9 million. Brisbane going up another 10%, median close to 1.2 million. Melbourne up 8% with a median close to 1.2 as well. Perth is expected to hit over $1 million at 1.05 million. Yes, most major capital cities will now require about $1 million to buy a home. And here is the crazy part. Even the lowest projections still show between 5 to 7% annual growth. This means that if you already own property, 2026 is looking like a very profitable year ahead for you. And if you don't, waiting could cost you hundreds of thousands of dollars sitting on the sidelines. But why is this happening? Let's break it down. There are 5 major forces pushing the market higher, and all of them are aligned. Firstly, we have demand, which is absolutely surging. Interest rate cuts might be delayed, but customer sentiment is still rising and looking very positive. Pre-approval times across banks have blown out massively as borrowers have come back in huge numbers. Secondly, we have migration, which is still extremely strong. Australia's population is growing quickly, and with an aging workforce, migration isn't optional, it's essential. More people means more households, which also means more demand for housing, which should be continued. Thirdly, we have severe underbuilding that's happening all over Australia. Almost every state has fallen miles short of the construction targets that we had set. So even if the demand was to somehow slow, prices would still continue to rise just because supply simply can't keep up. Fourthly, rents are at record highs. Rental vacancy rates are at 1% or lower in many of the regions that we're investing. And this means properties are easier to rent out. Rising rental income also is a benefit, and better holding costs, and more investor demand as well. Fifthly, investors are returning stronger than ever. And even as a buyer's agency that buys 4 or more properties every single week, we are experiencing this firsthand. At Handle Properties, our goal isn't to match the market, it's to significantly outperform it by a considerable margin. If the market grows 5 or 10%, our goal is to get somewhere between 10 to 20 for our clients. How do we do this? Well, we use a data-driven approach with more than 30 indicators, some of which include inventory levels, so think days on market or other buyer search demand, perhaps rent to income ratios, infrastructure pipelines, employment drivers, and of course, supply constraints. And more importantly, we buy before the headlines hit. Many of our clients in 2025 saw 6-figure equity gains in under 12 months. We expect more of that to come into 2026. So what exactly are we looking for as we look into 2026? Firstly, we want to continue investing in suburbs where supply is locked in. No house and land estates, no oversupplied apartment zones, no flood of future supply. Secondly, suburbs with surging buyer demand. We track rising investor interest, online searches, auction data, and private buyer activity to get confidence on demand. Thirdly, we also want to buy in areas where the rental markets are exceptionally strong. So looking for low vacancy rates, ideally 2% or lower, or even better if it's around that 1% mark. Fourthly, we look at infrastructure catalysts, whether that be hospitals, transport, upgrades, university expansions. These are what create long-term uplift. And the fifth item is buying in markets early in their cycle. What is the biggest mistake that investors make? Well, they buy way too late. We buy in early stage markets for 5 to 7 years of compounding capital growth, or in later stage markets, but that still have significant upside over the next 12 to 24 months that allows your equity to be built up rapidly. We then match the suburbs to the investor's exact strategy so that they can get the capital growth they are looking for. Here's the truth. 2026 is shaping up to be a monster year for property investors, and the decisions that you make now will shape your financial future over the next decade. If you buy strategically in the right markets, you can recycle equity more quickly, grow a multi-property portfolio, and accelerate your path to financial freedom. But if you wait, you could be buying at far higher prices with much more competition. If you want expert help to position yourself for one of the strongest markets that we've ever seen, reach out. At Handle Properties, we buy 4 properties a week, and we help our clients significantly outperform the market every year. Like, subscribe, and comment if you want a follow-up video where I reveal our top suburb picks for 2026.